Okay guys, welcome to another video. This is a continuation of a series that I'm working on these special purpose acquisition companies, these SPACs or SPACs that go out into the market and acquire these private companies and turn them public. This one I want to talk about Lightning eMotors and the deal that they've announced with GigCapital. I want to talk about the bull case and the bear case on this one. So on the bull case side, I've got 6 things to tell you about supporting the bull case. I've got 5 things supporting the bear case. At the end, I'll weigh it all up, let you make a decision, and give you my opinion. Let's get into it. Okay, so first if we take a quick look at what Lightning is and what they do, it's a very simple and easy to understand business model. They're basically into converting gas and diesel bodies into fully electric vehicles, zero emission vehicles or ZEVs, and they're focused on this medium duty urban commercial space. So unlike a company like Nickel that is looking at these long haul trucks and things like that, they're focused on a little bit smaller. These are called class 3 to class 7 vehicles. And there's an example here of what these are, from their investor presentation. Class 3s are your ambulances and your airport shuttles, these boom trucks. Class 6 vehicles are these larger delivery ones, and it goes all the way up to these buses. And another thing that makes this market interesting is that the characteristics of the EVs that they're building and converting are a little bit different, right? Because these are stop and go vehicles typically. They don't need a ton of range. They don't need to be charged all that frequently. So it's a different sort of game on the battery space. But these things actually do typically need more power because they're hauling cargo in some circumstances than a typical passenger vehicle might. So the way that they do this is really important. They don't manufacture their own bodies. Instead, they go out and they buy a chassis typically from Ford, and then they'll convert it over to electric. Now, of course, they're not stripping out the gas and diesel components. They're actually buying these special purpose empty chassis, essentially, from Ford. They're adding electric drivetrains and turning them into zero emission vehicles with their own software and their own customizations in the cab, the whole thing. So you do absolutely get a real zero emission vehicle out of this thing, but you also benefit from the fact that it's based on the Ford chassis. So all your aftermarket parts and accessories and things like that largely will continue to work on these bodies. And because they're part of this Ford QVM program, this Qualified Vehicle Modifier program, the warranty is still intact. And it's basically like buying a new vehicle from Ford. Typically the same MSRP, which is interesting. The price point that they're coming in at is very much equivalent to these gas and diesel bodies that you could otherwise buy. And they have a little bit of a service offering on top of this conversion business. So they have their own software, they have some analytics in terms of fleet operations, they do mobile charging, and they offer some finance. So they're not just building out these bodies, they're expanding the ecosystem a little bit. They're certainly not what I would call a full stack EV manufacturer. They're not a manufacturer at all, but they do have some elements of the full stack that a fleet operator might be looking for.
What's the upside potential?
Okay, so let's get into the bull case on this one. The first point right off the bat is that they actually have real customers, which is very, very nice to see. If you look at where they are in terms of the cycle, they certainly are early stage. They're out there talking to customers. They're doing these proof of concepts. They're doing trials, which is always the initiation of the sales cycle when you're dealing with these large commercial customers, right? You have to get in. You have to prove yourself. You have to do this technical validation. You have to get to the point where they're going to order a bit of a fleet. They're going to try it out, and then you want to get into that final stage, which is these repeat orders as they grow their fleet over time, and then you become deeply embedded with the customer. So I think they have a success story about the early stage validation of this sales cycle. They're out there with some real customers, big names too, right? These are not just small mom and pop shops that you typically see on the customer base for a company like XL Fleet. These guys have a pretty good story of larger customers that are at least trying them. Amazon and DHL are both in that customer list. Not an exclusive deal by any means with either one of those, but at least they're in there. And I think these larger fleet operators are trying out some of these different companies to see who can do the best job, who has the best execution. And so, these guys actually have a real shot at getting into some of these bigger customers. Point number 2 is I like the fact that these guys are going full electric. Some of the competitors in this space are going with a hybrid hybrid conversion model. And I think the key differentiator there is that hybrid has a shorter lifespan and a more limited jurisdictional market that they can get into. There are some jurisdictions that are mandating zero emission vehicles by a certain date. And if you're coming in with a hybrid model, you're not necessarily going to meet the more stringent targets. So sure, you can play in these markets where the regulation hasn't clamped down quite as tightly. But California, for example, you're not going to be able to play there. These guys are, and that's actually their strongest market right now, is one that's driven by really, really tight regulation. So I like the fact that they've had the foresight and the courage, I guess, to jump all the way into ZEV and skip that hybrid step. It's a good sign. And speaking of the competition, that's point number 3, really. The competitive landscape at the moment is really favorable for these guys. They are ahead of everybody. They're deeper into that sales cycle than anybody else that's in this business. They've got a good chunk of this market share under their belt already, and they are definitely in the lead position in this market space, which is really good sign, and it's good to see. There are companies coming up behind them like Canoe, PIC, XL Fleet, but these, not only are they behind these guys, but they also have slightly different business models. They're not in this pure conversion space with zero electric vehicles. You take Canoe, for example, with the skateboard thing. It's special purpose. It's targeting a specific set of requirements. It's not this broad scope conversion that these guys are now the leader in. Point number 4 is regulatory change. That's really the key thing here. That's what's creating this market for conversion of these vehicles. And it comes at a time when you can't really go out and buy these things, right? So we have this heavy pressure from the regulatory bodies, these governments that are mandating a move to zero emission vehicles. They're really hard on this. They've set some timeframes that have to be met, and these large fleet operators don't really have a good option to simply go out and start buying new vehicles to meet this need. They need a stopgap measure, and these guys and their competitors to a degree are stepping up to meet that. So it's really great to have this forced market. It makes for a highly motivated customer base that needs to come to you and take up the solution that you're offering. Okay, so the next point is their growth story. And this, to my mind, is the single biggest factor in the bull case for these guys. Their growth story is really, really fantastic. And, if you look at this slide, I love this slide, and I think it really speaks to the growth of this market over the next 5 years or so, 4 to 5 years. I think that this is real. I believe their numbers here. If you look at some of the underlying market dynamics and what's happening here, I think especially in California, they can really recognize a lot of business that's coming into the pipeline. They're already seeing that. They have 9 out of 11 customers currently operating their vehicles, at least in that early stage proof of concept capacity, and the pipeline is filling up, right? So can they achieve this kind of growth over the next 4 to 5 years? Yeah, I totally believe that they can. And then the last point on the bull case here is the valuation. The valuation both in terms of the deal that's being conducted right now with GigCapital and their overall valuation in the market, even at the current share price, it's reasonable. You can actually buy this company at a reasonable multiple, and it compares favorably to the competition and their peers in this EV space. Now they compare their valuation to a lot of different companies. That's probably inappropriate, right? I mean, looking at their valuation compared to a Tesla or a NIO or something like that makes very little sense to me. But if you line them up against Nikola, XL, Canoe, Hyliion, these ones actually make a little bit more sense, and the valuation multiple is a good deal lower than some of these companies. So I do think that's a point in favor of the bull case. However, there is a reason for this lower valuation, which I want to get into in the bear case.
Let's talk about risk.
Okay, so point number 1 on the bear case here is that I'm not all that excited about GigCapital. I don't really know what they're bringing to the deal here other than money. So sure, they're backing up the truck, they're dumping a bunch of cash into Lightning, and if that's all that Lightning needs is cash, then fair enough, that's a good thing. But typically in a lot of these reverse mergers, it's really nice to see that the big pile of cash actually comes with additional management expertise expertise that the target company might be lacking. You kind of want to see that additional expertise being brought to the table as part of the deal. And on this one, I don't see it happening. I think that GIG is basically a SPAC in a box. They're really trying to almost franchise this sort of reverse IPO business. And really, I think my concern there is that they're just looking for a quick buck and an exit event. I don't necessarily know if they're really the experts in this particular vertical, and they're looking to stay with the business for the long haul, and that concerns me. Point number 2 has to do with this idea of a competitive moat. And, I kind of don't like the way that they are overstating the competitive moat that they have. I think they have more of a mud puddle than a moat, to be honest. They talk about their proprietary transmission, this modular architecture that they have. They talk about their analytics software, the service network. These are all uninspiring things in terms of a competitive moat. They're very minor, and I think they're really overstated. I don't see that it's all that difficult for somebody else to come in and do the exact same things. It's a similar story on their intellectual property and their patents. They're calling attention to some highly specific patents and very limited scope technologies that they are claiming as IP. And yeah, they have these things, but how important are these? How crucial are they? How difficult is it for somebody else to play in this space and do the same thing? I don't think it's all that difficult at all, and I think they're really overstating the competitive moat that they have. Point number 3, I think, is that overall, the market opportunity and the timeline for this conversion market is inherently time limited. At some point, the OEMs, the Ford and the Chrysler, and maybe even specific EV companies like Canoo or Rivera, they're going to come in here and they have the potential to crush this conversion market by offering their own full stack EV solutions. And then this conversion business is inevitably going to dry up at some point. Now, I don't know when that's going to happen. I don't think it's going to happen within 3 to 5 years. So I think in this short period of time, these guys are going to do very well. But I'm really concerned about the long-term prospects. As this market matures, are they going to get squeezed out? And even their analytics software and the algorithms that are behind some of this, those also seem unremarkable to me. Fleet management solutions in the enterprise space are really mature. And so the capability for one of these vendors to simply tack on EV analytics to their existing software suite seems like a really easy thing to do. It seems like a no-brainer. And then you would get full fleet operations management in a software suite that's highly integrated with other systems versus this highly focused special purpose solution that Lightning has. I don't really see that as a big deal. Okay, so next on the bear case is the numbers. They have this projected path to profitability, and you really have to look at the difference here between the EBITDA number and the FCF, the free cash flow number. So they have a reasonable path to profitability based on the EBITDA projections that is probably realistic. However, on the free cash flow side of things, even out into 2025, they're projecting $50 million of profit on a $2 billion revenue stream, which is really minuscule. And the reason for it is the heavy CapEx that they're projecting in the short time frame. And the reason they're doing this is they're attempting to invest in and develop what they call EV as a service and energy as a service. And so the CapEx drawdown that's going to take in the near term is really going to crimp any sort of path to free cash flow based profitability in the short time frame. And that's a risky bet. Now that brings me to point number 5, the last one in the bear case, which has to do with this CapEx spending that they're doing. The reason for this is their attempt, I think, to pivot eventually to EV as a service and energy as a service. Now, I have a number of problems with this. One is these are just buzzwords for leasing and charging. It's not all that difficult to do these things, and other companies do them better. Also, these are non-existent services in their current business model. So really, they're attempting to pivot to something that they haven't yet done. They're only in the very early stages of attempting. And it remains to be seen if they can execute on those two things. And also, it remains to be seen if customers actually want these two things. Energy as a service, especially charging or mobile charging, it essentially means competing with companies that already already have very, very well developed charging networks and are adding their own fleet management capabilities to those charging networks. I don't necessarily see that these guys are necessarily going to win in that space. And then the whole EV as a service idea, which again is just leasing, I think could be totally blown away by the OEMs that come in here and offer their own leasing business that they already do anyway. I don't necessarily see that these guys have any differentiator or any competitive moat in either of these two services that they're attempting to pivot to. Now, if they were going to try to completely outsource fleet operations, that would be a little bit more interesting to me, but they don't claim to be doing that. And even if they were, again, I don't know if that's what customers want in this space. Okay, so let's try to sum this one up. To my mind, the bull case and the bear case are kind of experiencing this interesting dynamic based on time frame. I think the bull case would win if you could constrain your view to the next 5 years or so. In that short time frame, this looks like a really, really solid business. I think they can actually make a lot of money and they can be profitable in that short term. So in order to confirm the bull case, I would need to see a few additional things. Number one, I would have to see some reassurance that the OEMs are not going to enter this space and crush them. I would need to see a solid strategy to pivot to some sustainable business in the next 5 years. And finally, I would like to see a broader base of in-house technology, patents, some kind of thing that they have that nobody else does. And at the end of the day, none of those things are in place at the moment. I don't necessarily see them coming. So because I take more of a long-term view of these sorts of investments, at least to me, the bear case is confirmed on this one, and I think I would stay away. That said, if you're more of a trader with a short-term mentality on this one, and you're either looking to play the pop on the news when the deal is confirmed, or you're looking to cash in some of this early stage growth and then get out, totally viable strategy, and I think you could probably do quite well. So that's it, guys. I'm going to wrap this one up. I hope it helps. Please throw the video a like if it did. Consider subscribing and ring the bell, and I'll see you on the next one.